Hey everybody, my name's Kelham Brown and this is the UM Show, the Upside Mortgage Show, and I go by the Mortgage Official. By day, I'm a mortgage loan originator in the Dallas, Texas. But by night, a varsity basketball official around the Metroplex. And joined with me here today is Dave Brown, the mortgage coach. Over 20,000 hours of mortgage coaching experience and over billions and billions of dollars of loans closed. Dave, how are you on this cold day?
Mortgage Official, I am fantastic and I am ready to have a great time. And I'm excited about bringing a good show today with a lot of great content. So let's let it roll, man. Let's go. Let's get this thing started.
100%. And our topic of the day, Coach Dave, is down payment versus closing costs. What does it actually cost to get into a home? Because we see the purchase price on Zillow, on Realtor.com, but that's not what they pay when they're financing a home.
Kelham, that is a great place to start. Okay, so here's the question that I see all the time from first-time home buyers and people that are renting. Maybe they've owned a home before and they're wanting to get back into a home, and that is, how much of a down payment do I need? Right? That's really the question that we hear all the time. Do I have to have a 20% down payment? And the answer is no. This is not your grandfather or great-grandfather's mortgage where you had to have 20 to 30% down to get a mortgage. Okay, so that's a myth. Let's throw that out the window. And then on this show, we're going to talk about the difference between down payments and closing costs. And I can't wait to dive into that. But a big part of what we're going to be doing here is showing you today the different programs of how you can get into a home with much less than 20% down. And I don't know, Kelham, do you think anybody would be interested in hearing about how to get in with like zero down? That's a zero. There you go, zero down. All right, so let's get this thing started. Exactly. Wait a second, Kelham, that's pretty darn good. Let me see that again. Come on.
The zeros, the vision. I see where you're going with it. 100%. So how much do people need down? Generally changes from person to person because not all shoes fit the same feet. Not everybody fits into the same bucket of qualification. I know you said zero. Some people still think they need 20. How do we get to the bottom of what bucket you may actually fall in?
Yeah. All right. So here we go. Let's talk about this. Traditionally, last year throughout the year in 2025, the average down payment was somewhere between 16 to 19% for all home buyers across the board throughout the country. All right. But for first-time home buyers, that ranged between 6 to 10% on average. So that's an important number to realize. First-time home buyers across the country got into homes with as little as 6 to 10% on average. But what they aren't taking into account for, and I couldn't get statistics on exact numbers of how many home buyers chose 3% down and or 0% down programs in 2025, okay? But I can tell you just from the people that we work with, I would say, somewhere between 35 to 50% of the people that we work with that are first-time home buyers choose anywhere from a 3.5% down program or less. And I can't wait to break that down with you here, and because there's some exciting programs that we'll talk about.
100%. Because people want more money in their pocket nowadays. They want to be able to make their dollar go as far as it can. And so with those programs that allow you for a lot less down, you'll be able to deploy those funds to other things, whether that's other savings, other investments, or just keeping it for a rainy day. So if someone has very little saved, are there ways to get down to that 3? And I know you even mentioned 0% from those programs that people may or may not be aware of. What are those?
Yeah, so let's start with, I'm going to start with the zero down programs here, okay? So first of all, we have to give tribute and respect to our veterans, okay? So first of all, if any of our listeners are veterans, you can qualify if you have enough time served in the service. You have the ability to go with a zero down mortgage utilizing the VA loan. All right, and thank you for your service. We then have a program called USDA. Now, that's under the United States Department of Agriculture. Now, Kelham, we're not talking about like cornfields here, but the thing that I need people to think about is, let's just take DFW here. If you're in the DFW metro area, kind of what I call the metroplex, most likely those areas are not going to qualify for a USDA zero down payment loan. But when you get even maybe 30 miles or 30 minutes outside of the city, okay, in different areas, then those areas, there are established approved areas by USDA that will allow you to have a zero down payment loan. Okay. Now, there are income qualifications for that particular program. And that's one of the things when we put together our slam dunk game plan, we talk about with you what are those income guidelines for different areas. And they're different based upon county and states around the country. Then, Kelham, I'm going to talk about 2 additional lower down payment programs. That is a 3% down conventional program. All right. Now, when we start talking about Fannie Mae and Freddie Mac, we've got some really cool things here to talk about. So Fannie Mae.
Dave, who's Freddie? Who are you talking about?
Oh, wait a minute. You guys don't know Fannie and Freddie, do you? Okay.
Who are they? Are they married?
All right, let me back it up. Did I just get a technical foul for like
you're on thin ice?
Okay. All right. So here we go. So in the mortgage world, if you do any research, you'll hear the term. I talked about VA. I talked about USDA. I'm now talking about conventional loans, and under conventional loans, where loans are purchased or sold in our mortgage industry, it's called Fannie and Freddie. That's just where loans are made behind the scenes. They're purchased. We don't need to dive into that today. I apologize. I got a little deep I got excited, okay?
You got excited.
Here's the deal. There are programs with as little as 3% down when you have a certain credit criteria for a conventional loan. Lower, and we'll get into this in a few minutes, lower mortgage insurance rates, but that's a 3% down. And then the final program that I mentioned or was going to is FHA, Federal Housing Administration. And that is a 3.5% down payment. Now, each of these 5 different programs have different qualifiers, such as a VA, you have to be a veteran, right? Or as an example, on an FHA, sometimes you'll study or see online, it'll have a minimum credit score, and there are different credit criterias and things like that on some of these different programs that we get into your specific situation. But I've just labeled 5 different types of programs that allow for less than 5% down payment when we started talking about, do we need 20% down?
We've backed it down from 20 all the way down to 3, and I think a lot of people would like that money in their pocket.
Not a bad way to go.
So we talk about down payment, but that's not the only cost associated when you're going and getting a mortgage to buy a house, right?
That is correct. And so I like to, and I know when you and I meet with a borrower, we like to break it down this way. Do you mind if I get the whiteboard out for a minute?
Bring it up.
Okay, so hold on for just a quick second. I'm going to pull up the whiteboard, okay? So I'm just going to write this down. So we have closing cost, which you just mentioned. We have down payment, and then there's a third category, which I'm going to write there. I'm going to write it down, okay? So we've got down payment, which we've just been talking about. We've got the closing cost, okay? And then we've got this third category, which is prepaids right here, okay?
I'm glad it's not just your PP.
It is definitely just not that, okay? It is the
not
prepaids, okay? Now, I'm going to blow technical foul. You're getting pretty close to getting too technical here, okay?
I'm getting a little out there, but we got to make sure the people know what they're paying for. There's a lot of P's in this operation. There are. All right, so here's what I've done. I'm just gonna show a couple of different numbers, and the first thing on the down payment, we've kind of already shown that we have programs with 0 down, and we talked about FHA at 3.5% down. I know this is scribbles here, people, and I apologize, but you're following me. But then on closing cost, depending upon where you live in the country, and let's say here in DFW, you have to factor in, so you have down payment, which we just talked about. Closing costs are things such as lender fees, title fees, getting an appraisal done, home inspections, things like that. All of those are considered closing cost. Fees associated with getting a loan, okay? That they range depending upon your area. They could be anywhere from 2 to 5% additional over a down payment. Kelham, let's not get everybody worried, because here's the thing. Working with us, when we put together a structured game plan for you, and then in conjunction with working with your real estate agent, we're going to try to help structure your offers, so that we're going to try to work with your agent to get the seller to pay these closing costs for you. How does that sound? Do you think people would like that, Kelham? I think you just scared a heck of a lot of people who I thought we just got this down to 3, and now you're telling we back up to 8? Exactly. What was the point of saving the money in the first place? But now that they know that they may not even have to cover those costs, I think that opens the door for quite a few more people.
There you go. And that's what we're trying to do. All right. So now the final category, your PP category, prepaids. Okay. So what are prepaids? Okay. So I'm just going to break a few things down. Prepaids are things, sorry about that. Prepaids are things that you pay either prior to loan closing, okay, or at loan closing for the future. I'm just going to name one. When you buy a home, you have to come to closing with your first year of home insurance. You can choose whoever you want for your home insurance. That covers fire, theft, vandalism, if somebody gets hurt on your property. If the pipes break, right now we're in a polar vortex. If your pipes were to break, hopefully with your correct home insurance policy, that would be covered, okay? But we require, as a lender, all lenders require the first year to be paid at closing, so it has to be prepaid, okay? That's why it's called prepaid. So let's not get into the weeds too much, because we're not going to get a technical foul. The point is, it's another category of monies that we have to account for. But if you structure your offer correctly by offering the correct price instead of trying to, let's say, undercut, or, my dad always used to tell me.
I think the word you're looking for is lowball.
Lowball. Okay. If you try to lowball the seller, well, then they might let you lowball the offer, but then they're not going to pay additional fees for you. So this is where we come in and we structure this so that you can get these things paid for you by the seller, so that all you have to come in with is your down payment. Okay. But these are things that we have to talk about when we're putting together your pre-approval, okay? We have to talk about them so that you know how to correctly structure an offer to get you into the home, the right home, with the least amount of money.
100%. So we talked about how they can get the closing costs covered, and that's through the seller. Are they able to borrow their down payment or get that from other means as well if they've been paying off debt or other things and don't have the on-hand cash?
That's a really good question. I'm going to answer it quickly and concisely 2 ways. First of all, there are ways that you can potentially borrow for your down payment if it's from a secured fund. Let's keep it real simple. If you have, let's say, a 401k, many 401k plans will let you borrow against the 401k, and sometimes you have to pay that back with an interest rate to yourself, but that is allowable or allowed when you're getting a mortgage. If it's a secured fund, you can borrow against it. Now, you can't just go put money on charge cards and cash advance charge cards. That's not considered a secured fund. All right. So can you borrow money in the right instance? Yes. The other thing that you need to be aware of, we also do have grant programs. So let's say you don't qualify for a zero down program. We do have available grant programs, and every state has different programs, but we have some pretty crusher grant programs where we can get you your down payment money in certain circumstances. Some of the grants are repayable, and check this out, Kelham, some are even forgivable where you don't even have to pay the down payment money back. So we can get you, let's say, 3 to 3.5% down without even having to pay that back in some cases. And this is where we talk through this when we're putting together the slam dunk game plan for you. These are the kind of things we discuss.
So you're telling me there is such thing as free money?
Well, as free can get. There is availability, and you know what? Sometimes free money, even if there's a cost or a payback on that, when you understand what that is and the advantages, it's as close to free as free can get. So yes, sir.
I love it. Well, Dave, we're down to our 2-minute warning. So share with the people one more mistake or tip that costs people the most time or money when it comes to their down payment.
Just one?
I can get you a second one, but you're on the clock.
Oh,
Shot clock's coming down.
We're in the 2-minute drill. Okay, so here's what I would say. I have found in my experience that too many home buyers think that they need more money out of their pocket. So they wait, okay? They put themselves kind of on a 2 to 3 year savings plan to save up more money or to get themselves in what they perceive as a better position. When in reality, what happens, as an example, Kelham, let's say today you're looking at a house that's $300,000. But you don't maybe think you're in that position to be able to purchase it. So next year at the same exact time, if that home only goes up in value 2%, right? Only 2%. So think about that. So now all of a sudden that property has gone up again. It's not 300,000 next year, is it? No. Yeah. So think about that. Yeah. Now, 2 years from now, that property goes up another 2 to 3 to 4%. So all of a sudden that home in 2 to 3 years, it was 300,000. You've been saving for it. 3 years from now, that home could very well be anywhere from 330 to 350,000 asking price. Now your grand plan of saving money, now you don't have enough money again because you're now needing more money because you're buying something at a higher value that you could have purchased at a lower value if you just had the slam dunk game plan and knew your numbers. Once you have your numbers, then you can make an educated decision. Do you want to wait a year or two? But you just have to factor that in. That's probably the biggest thing that I see people make a mistake relative to waiting and their down payments.
That's great, Dave. Well, that concludes our 2-minute drill and this episode of the UM Show. And Dave, that's the game.